Trends in Food Manufacturing was a live webinar that was originally produced on Thursday, October 20th, 2016. The presenters for this presentation were Janice Snyder, Kurt Tremarchi, Michael Hoffner, and David Blaine, all with McConley and Asbury. Enjoy this webinar recap and visit us online at www.macpas.com for more information about our future events and presentations.
Thank you, Tyler. My name is Janice Snyder, and I'm a partner here at McConley and Asbury, and I've spent over a decade working with food companies, particularly on their financial statement audits, but in various other capacities as well. We're very glad you can join us to talk about this wonderful industry, which comprises about 21,000 companies in the U.S. and is $760 billion in revenue, so certainly not a small topic. We're going to spend today talking about current financial trends, mergers and acquisition activity, and preparing for business transition, buy, sell, and mergers. A lot of that, you're going to hear some of the trends going on in the industry, whether it's organic or non-GMO or artisanal or less sugar or low sodium. Certainly a lot of trends out there and consumer-driven trends that are driving a lot of these numbers. So we're going to talk a little bit about that and how that's being affected by a lot of the merger and acquisition activity. So Michael Hoffner, one of my partners and a CPA as well, is going to talk to us about the current financial trends, and he's going to turn it over to Kurt Tremarchi, and he's going to tell us what's going on with mergers and acquisition activity. That David Blaine's going to talk to us about mergers and acquisition, and David's going to talk to us about preparing for business transition, buy, sell, and merger activity. So we certainly appreciate your time this afternoon, and I'm going to turn it over to Mike.
Thanks, Janice. Happy to play the role of the economist today and spend a little bit of time talking about trends in the industry. Not going to go into a tremendous amount of depth, as those on the call who work in the industry and in suppliers and producers understand that every sector of this industry has a little bit of different influence, a little different outcomes. So we're going to talk very broadly today. We'll talk revenue and profitability, two of my favorite things, of course. I prefer profitability over revenue if I had to choose one. We're going to talk a little bit about significant influences on the industry and some of the impact on certain sectors, and we'll just focus in on a few of the larger sectors in the industry. And then we'll talk a little bit about industry projections. One of the things I will be going over really is revenue data from two different sources, and I just want to share a little bit about where that information comes from. So first and foremost, as we go to some of the trends in revenue, much of this information on the first few slides will come from an organization called ProfitSense, or SageWorks, a product called ProfitSense. ProfitSense is actually a real-time database of financial information input by accounting firms like ours relevant to their clients, and it's all anonymous data. And what I would share with you is that some of the information you're going to see on the next two slides may not be consistent with your experience because it is very isolated to firms that use the product and is not terribly broad-based. So it's limited, but I think very useful information to talk through. The other source of data is the IBIS World Industry Analysis. These are very comprehensive programs, comprehensive data that go through significant depth on industry sectors. And I would offer, if there's any level of depth that you're interested in coming out of today's webinar, please reach out to either Janice or myself, and we can track down more granular information for you. So again, we're going to stay at a high level. It'll be a little bit for everybody. Not a tremendous amount of depth on any specific industry sector. And keep in mind, as I will always point out, I'm not an economist, I'm just an accountant. So we'll jump right into some of the details now. Tyler, if you'll scan us to the next slide. So first and foremost, I want to talk a little bit about revenue trends that we're seeing. So the statistics on the screen are focused on 6 key industries, key sectors in the industry, for which ProfitSense has a decent amount of data. We try and avoid the industries where accountants have only put in maybe 3, 4, 5 entities worth of data. So we're trying to focus on the ones that have actual significant amounts of data to draw from. These are the 6 that made the most sense, not only from the McConley and Asbury client base, but from a broader perspective. So as you'll see, we're seeing continued growth. However, that growth is not quite at the level it was. Coming out of the post-recession lows, we saw some tremendous growth over the last few years. However, that's decelerating. Much of that has to do with Just general industry focus. Much of it has to do with consumer confidence, while continuing to rise, is not certainly rising as quick as it did post-recession, and continuing, hopefully, as we look into the near future. We'll talk in a few minutes about industry-specific growth projections. So you'll see in detail each of those industries. I'm not going to go through them all, but I will tell you one thing to take note of. We're going to talk a little bit later about the forward-looking projections by industry come from the IBIS World Reports. These come from the Profit Sense data. The IBIS World Reports include much larger entities, conglomerates, multinationals. This data tends to be more focused on smaller entities, the mid-size operators in each of these industries. So I will tell you that the IBIS World Reports, if you dig into those, will tell you, and other general industry data will tell you that the growth numbers are actually less than what you see here over the last few years. So an indicator that the large multinationals are experiencing smaller growth than the small and mid-size operators in the industry. So certainly very important to note as well that the trailing 12 months information on this screen will change over time. That's only as good as the information that's put in. And as we approach year end, when we get into spring, there will be a significant number of clients and entities input. So if we have this conversation again in March, we'll see different numbers here. And I do invite you to reach out if you're interested in what that data looks like, and we can certainly provide it for you. So in summary, again, we're growing. We're just not growing as fast. As I said a little bit earlier, my favorite is profitability. Profitability is more important than top line, and many times we focus on, and I encourage you to not focus on revenue growth at all costs. Sometimes boards, stakeholders, we focus on that top line number. In my mind, while important, it's better to have smaller profitable revenue than larger unprofitable revenue. So I like this information better. Again, this information comes straight from the SageWorks and Profit Sense data, so it does exclude the large public and the multinationals. Important to note that commodity prices have been relatively stable. And if anything, commodity prices have dropped. Cattle and hog prices have reduced pretty significantly from 14 and 15 spikes. We had droughts, we had disease, we had fears in the hog market. But in general, as commodity prices have stayed stable, gross margins have stayed strong and increased. What you're seeing here, though, is a reduction for the most part in overall margins, and that reduction and that trend is a lot because of SG&A. Organizations through times of strong cash flow have invested in process improvements, have invested in equipment, technology, and as they make those investments, there's an impact on SG&A, and as that impact occurs, you'll see stable profits, but certainly not growing at the rate you might hope for in a time when commodities are flat and decreasing. I would offer that Moody's recently released their outlook for the packaged food industry. Packaged food industry has been upgraded from stable to positive outlook, and it's a lot of the things that we just talked about that are driving that upgrade. Top-line sales aren't going to grow significantly. We'll talk about that in just a few minutes. But as top-line sales stay relatively stable with small growth, all these investments that have been made in process and equipment will be paying off, and Moody's does expect the profitability component in the packaged food industry to continue to grow and improve. So good news when we look long-term on the profitability perspective.
Hi, Mike. As we look at these, it looks like frozen food is really the winner in both revenue growth as well as profitability. At first, I found that very interesting, as that seems to contradict a lot of the push for fresh and healthier. But if you look at a lot of things being frozen, you can flash freeze produce, you can do it with breads and bakeries and a lot of other products, which will give you a longer shelf life, to be able to freeze them, less spoilage, and is more sustainable.
Yeah. Absolutely, and one of the things we'll speak about in just a few minutes is the trends that are affecting frozen foods and how they're taking advantage of some of the consumer expectations in the marketplace. So, great observation. So,
just to add to that quickly, Mike. Just to add to that, I have a client that that is thriving off the frozen food market right now, specifically on the meat side, because they can get the meat at a little bit of a reduced cost. It's still fresh, even though it's frozen. But ultimately, at the end of the day, that has helped them with their profitability and their revenue margins as well. So.
Absolutely. So let's talk just for a few minutes about what's driving some of our growth and change in the industry. First and foremost is per capita disposable income. Over the last 5 years, the amount of disposable income in an American household has increased steadily, and as we all know, when there's improved cash flow in the household, the pantry's stocked more comfortably, and often, particularly in the higher wage earners side of things, there's a greater shift in comfort in spending money on perceived premium products. So there's certainly a drive in spending, and while again there's not a significant expectation of huge top line growth, as there's a perceived interest in premium product and there's a expectation that there will be dollars available to spend on that premium product, it's allowing for additional profitability if we're positioned correctly, and that's really what it's all about, is understanding these trends and positioning yourself to take advantage of them. There's also a trend in some sectors, not all, with some of this focus on available cash flow and an interest in the consumer and premium products. There's an additional level of new entrants into the market. There's money in the marketplace to back exploratory products. There's money in the marketplace to back startups. Kickstarter, every now and then you see a unique new product come through Kickstarter and crowdfunding. And so there's a more of an interest with this perception that we can take advantage of a consumer trend. There's more of an opportunity if capital can become available for small players to enter the market. And I think we'll talk a little bit later on today about consolidation and combination and how what we're seeing today with new entrants may drive that in the future. So the other thing, as we go into consumer trends, it's important to note that we only have an hour, and I was only given a few minutes, so we could wax poetic on a lot of things. Animal welfare and the rise in concerns about animal welfare and the interest in consumers on a term that actually was new to me not long ago called plant butchery, meat eaters exploring replacing their meat with plant-based options, food waste repurposing. What are we going to do with the disposable parts that come out of the production process? Shift to convenience and what we do there, ethnic influences, importantly trends on the food labeling requirements and how we address those. These are all things that are going to drive how we make decisions. Today we're going to focus on really what we're seeing in consumer behavior, though, which is dietary and health considerations and how that's affecting some of the key industries. You've heard all the terms, and those who are working actively in this industry: non-GMO, gluten-free, allergen-free, all-natural, low-cal, low sugar, low salt. These things have become incredibly important to the consumer, and the players in our industry that really are going to be successful over the next 5 years are those that react to that trend and have been reacting to that trend over the last year or two. Last year, a Nielsen survey on global health and wellness indicated that 88% of people who were polled are willing to pay more for healthier foods. All demographics, young to old, wealthy, lower income, all are willing to pay more to be healthy if they can afford it, and we see consumer trends in disposable income. And they're also looking for functional foods. We're willing to spend more on foods that are high in fiber, high in protein, fortified, have whole grain. So all signs point to this is a trend that's not going to let up, and things we need to stay focused on really is how do we capture the consumer's interest and drive the economics of your business in these key areas.
Yep. Mike, I've definitely seen companies that are focused on non-GMO, less sugar, but I also see with the specialty grains, I mean, the number of flours that have become more popular and been emerged, like black bean, brown rice, chickpea, coconut flour, all those sorts of things which go hand in hand with the gluten-free trend.
Yeah, and Janice speaks as one who understands that intimately. I just eat, so I understand what I read and what I study. So absolutely something we ought to stay focused on. And I'm not going to go through everything that's in the slides. There's certainly things in every industry that you need to be aware of. But again, considering as it relates to your industry, what are the premium offerings that can be introduced? There is certainly a trend towards consumer interest in premium offerings, but repackaging a legacy offering as a premium product or reworking, reformulating ingredients on legacy product does not tend to have as much traction. It certainly may help in this environment, but what we're seeing is new niche offerings with a larger volume focus in the consumer on those items. When we get into snack food, that's an area that certainly I think we could probably spend an entire webinar talking about snack food. We have this dichotomy of what we want in terms of our passion and our interest for snacks and for chocolate and for confectionaries, but yet we also have this consumer trend towards healthy, what's better for me. And so the confectionery entities and the snack food entities that really hybridize those two ideas are the ones that will be successful going forward. The other thing to keep in mind is marrying convenience and nutrition. And that's where we talk about frozen foods. And as Janice pointed out, the idea of taking frozen food to the next level. Frozen food was always the convenience alternative, but it wasn't always viewed the same as fresh. And as frozen producers and operators tend to focus more on how do I take that fresh product and freeze it and distribute it in a way that still feels, tastes, touches, it still seems like it's fresh, has the nutritional quality of fresh. Those are the companies that will be successful. However, that convenience is also facing an onslaught by fast food industries. As you look at fast food providers, there continue to be a drive towards healthier options on their menus. And so this idea of convenience in frozens is really being challenged by convenience at the drive-thru. If I think, and my perception is that I can get healthy food at the drive-thru as well. So similar themes through all industries, and it's really, as I said, the organizations that understand how they can adapt to that trend and have already adapted to it are the ones that we'll see as successful, and the ones that we'll see some tremendous growth in, and maybe counter that 1 to 2% at most growth trend over the next few years. Finally, just some industry projections. These items, again, come directly from IBIS World Projections and Snapshots, and so I think we could go to, and I went to a few different sources of projections and data, and you'll see different numbers in different places. But just for what it's worth, animal processing, meat, poultry, not a significant growth area, not expected to grow significantly top line. The growth will come in the shift to more premium products. There will also be expected vertical integration, and we'll get into some merger and acquisition activity here soon. But how do we make sure that as a producer, do I own the farms, do I own the feed mills, do I own everything that goes into that production to try and limit my exposure. So I think we'll see more of that. On the bakery and bread side, very minimal projected annual growth, but again, a significant shift to higher end product, artisan foods, perceived healthier options, gluten-free. There's also a significant trend towards investment in equipment, processes, and technology, with this understanding that I can't control the weather, I can't control crop disease. So if I control my internal processes, I'm prepared to adjust to a significant change in my commodity inputs. In the snack food industry, we'll continue to see new entrants into the market. I think the individual that comes up with whatever the next version of the kale chip is and takes advantage of the healthy option.
I think it's algae.
Algae,
I don't think I can get on board with that.
Algae may be the next kale, but there will be this continued shift towards snack foods that are based in an alternative product, whether they're plant-based or some focus on health. And if we can take advantage of that but still provide the joy of biting into a salty snack, then we'll be successful. But again, 1% at most annual growth projected over the next 5 years. Same for frozen food, not significant annual growth, but again, great investment in machinery, investment in what we're doing as a process will allow those companies, even in minimal top-line growth, to improve profitability and improve the bottom line outcomes. Finally, fruit and vegetable canning, confectionery areas, again, a little bit more growth on the fruit and vegetable side in confectionery than what we see in some other sectors, but not numbers that you get terribly excited about. The way we make those numbers work is to take advantage of consumer trends, take advantage of efficiencies, initiate lean processes, and try and really understand how to drive profitability through the things we can control, because it's difficult in this market to control pricing, it's difficult to control commodities, and it's difficult to control consumer behavior, but we can try and predict it and react to it. So Again, very 30,000-foot level. Certainly was not a deep dive into the economics of a food producer, but in the interest of moving on to what I hope is way more exciting and interesting than that, I will turn it over to Kurt to talk a little bit about the M&A environment.
Thank you, Mike. Hi, this is Kurt Tremarchi. I'm a partner with M&A. I do tax and transaction work. I've spent 2+ decades and about $12 billion in deal value in a variety of industries. So hopefully I can add some value today, although I will apologize in advance. When my partners invited me to a discussion about food, I thought we were going to lunch, but it turns out that we're having this webinar today, so I'll do my best to share some things. If you look kind of first and foremost, we'll just talk generally about the kind of where the marketplace is at the moment, not necessarily specific to the food industry. It's a hot market, has been for a number of years. We continue to see high multiples, which lends itself to really a seller favorable environment, as you can see noted there. We've had a number of clients sell in a variety of industries lately, and obviously the multiples have been quite attractive for their purposes, and we've seen big deal numbers, and I think that will continue to trend hopefully into the near future, although we'll see what the election in the future holds for us a little bit on the impact of the marketplace. As we know, marketplace doesn't necessarily like uncertainty. Demand for growth. Obviously, that's historically been a significant reason why we have a number of deals. The public markets particularly want to see organizations that are routinely growing and reward them for them, so that will always be a need to do that. If you think and listen to what Mike had shared earlier, obviously some growth challenges from an organic perspective, not the types of food, but from an internal perspective, is to where they're going to be able to find their profit levels and continued growth in that area. So they're looking to outside of their organizations to do that. Continue to be in a low borrowing environment. I mean, we still get excited about interest rates at 6, 7, 8% as though they're high, because we forget where those rates were at some points in our past lives, or at least the generation before us. And I think that then lends itself to why we can see some higher multiples, and why we're able to see a lot of deals, because there's still a lot of available cash and at low rates. Certainly competition from non-strategic buyers. We have noted it specifically private equity. Again, a lot of private equity funds have raised a lot of money over the past few years. They have a need to deploy those assets per their fund plan, and so we see that money kind of driving up values as it competes with some of the public market or other potential buyers, maybe from an internal perspective. Branded products can drive a premium. Obviously, it has to be in the right area and aligned with where the kind of the future is. But we see that across the board. I mean, name recognition means something, and brings inherent customer loyalty, and some maybe greater sensitivity or greater feeling that you'll be able to have a longer revenue stream as it relates to that versus private label or something that's not branded. And specialty products, clearly, I mean, I think as you heard Mike talk about, I mean, that's kind of where we're going as consumer demands change. We have noted craft beers, coffees. Obviously, there's a lot of different areas within the food industry specifically that would fall into that area, but I think it's important to understand how that might impact your business or your target business. Some factors I wanted to share quickly, just as it relates to specifically this industry. Obviously, we talked about low growth and mature markets. We talked about pressure on margins for a number of reasons that we understand. I think that one of the bigger areas, though, was really just the consumer changes, right? Who's buying? We have a younger generation that's really now entered to the marketplace and is significantly impacting the way they go about buying, their education, the information they share, what they expect from their food provider, and I think that's really impacting a number of organizations' ability to meet the marketplace needs, and oftentimes they'll look to buy specific companies to make that happen. Changing the retail landscape, just how they buy, where they buy. It's not me going to the supermarket with my mom like I did in the 70s as much as some different ways, although certainly the supermarket is still a viable avenue, but there's a lot of different retail pressures on that, and you need to be able to fulfill all of those areas. We're talking about competition from small, nimble companies. We're in a unique time period where the small player can actually partner with a lot of number of different folks, and that allows them to compete with some of the bigger individuals in their respective industries. So oftentimes we'll see deals driven by try and gobble up that. Operational efficiencies, I think that's what you're talking about, some of your consolidations and supply chain, and just trying to top down be able to meet and find all of that value that you can get in there. And certainly food safety regulations is something that we're hearing more and more about as it relates to the individual, to the company, as well as to some potential individual issues with executives in the future as to what their personal liabilities will be. I think that's more of a reason for individuals looking to get out necessarily than buy in, but it's an opportunity for people to do so. If you look at the next slide, we pulled some data that kind of shows a number of kind of multiples of EBITDA over the last few years in a number of different areas, and you can certainly take a minute and to digest that. I think you see that the average multiple in there in the lows or highs generally is probably pretty high, a little above average from maybe the 5 or 6 years before that. Again, good for sellers. And certainly can be good for buyers if they're buying in the right lines. I think the important thing is, if you're in any one of those areas, is to understand what drives the higher end of that within your specific business. You can get data that maybe would have 30 or 40 or 50 comparable type deals out there, and might indicate why one company or a series of companies sold at a higher value and why those is sold at a lower. And I think that's important information that we should have as we look to run our respective businesses.
Hey Kurt, just looking on here, and Kurt and I earlier this year worked on a transaction with a distribution company, and Kurt, I was just looking at that multiple for Q1 of 2016. That was pretty close to, I think, the multiple of that transaction that you and I worked on in the first quarter.
Yeah. I think ours was just a little higher, but generally in that area.
Yeah, so I feel pretty good about these statistics, Kurt. Good job.
Yeah.
Kurt, as I look at some of these statistics, Kurt, and having seen similar things before, I know a lot of these peaked in 2015 and were lower in 2010, so we saw a lot of steady increases. But a few of those multiples there, such as beverage and distribution and protein and even retail, are seeing some declines in early 2016. What are your thoughts on why there would be some slight declines in some of those areas?
That's a fair question. I mean, I think it's without understanding the specifics of the companies that are being sold. I mean, it's hard to understand exactly what's driving that. I think, again, some uncertainty in what the future economics look like for our own country. If we're talking about domestic companies, are reducing some long-term projections. Obviously, what's the benefit and to the buyer as to what kind of synergistic value they're getting. Also, I'm not sure, maybe Janice, specifically to this data, is if it's public market or private market, because that's going to impact certainly what we're looking at is whether or not we're having strategic buyers or not, because strategic buyers obviously are driving that multiple up, so there may be some influence on that. At least that would be my quick reaction to your question.
Okay. Thank you.
Certainly, just as I mentioned, if you want any more specific data on one industry, you can let us know, reach out to me or anybody, and we'll be happy to see what additional specific data we could get for your business. Just real quickly on a couple questions that we kind of thought about as it related to types of questions with the M&A, which is deal structures, tax issues, sources of funding. I mean, in our particular part of the world, I don't think that we get into a lot of exotic structures or funding sources, or even in the tax arena. I mean, our typical deals are primarily driven off of a traditional buying of stock or assets, trying to use, an all cash type deal. I know our selling side primarily would want all cash, not so much cash and stock. Certainly if you have a public market acquire, I have seen a number of deals where they would love to use, if it's part of their strategy, more of their stock as part of the overall purchase price to help reduce some of their cash burdens. But I don't think we generally see. And I don't know, David, if you've seen anything in your past here recently, and
Not
that
really.
I mean, it's
No.
pretty generic as it relates to our space. Tax, I think if you're looking at deals, generally we start off because everybody's tax advisor tells the seller to sell stock, and everybody's tax advisor tells the buyer to buy assets. That we always start off with some thoughts around what does a deal look like from a stock perspective, and what does that valuation kind of translate to. But as we migrate through those things, we typically will move into a number of issues around how do we buy the assets, whether that's a technique called a 338H10, which allows it to be a stock deal for all other purposes other than tax, and it's a deemed asset purchase for tax only, allows the buyer to step up the basis. Often it allows them to pay a premium above what they would pay for the stock because of the future benefits from depreciation and amortization. So my point here really is the tax is not to get so married to one set idea, is to establish some understanding of what a value would be around a particular structure of a deal, understand what the after-tax yield is to the seller, and then you can negotiate off of that to see if there's a way to change purchase price and deal structure maybe to assets that allows both parties to ultimately benefit in a little better way, and we routinely see that here. And as far as sources of fundings, I think we continue again mostly to see traditional financing in our world from banks, and certainly looking at some asset-based lending and how that allows the buyer to get there. There is an increase in obviously private equity, as we mentioned earlier, and certainly private lending sources that we not necessarily seen historically in our country. In Central PA, don't see it quite as much, but on a national basis, I see more and more opportunities where companies are looking or organizations are looking to private lending as a potential alternative if they're not able to secure funding in the way they want. And I guess lastly, if we could just share, I wanted to just before I let anybody go and just talk about mostly from a seller's perspective, some things that we've seen recently. And I know, David, you're going to touch about a little more into some specifics, but I just want to highlight a little of our experience of things that we're seeing right now, of areas that I would focus on if I was preparing my company to sell. And I think, unfortunately, organizations kind of wait until they get to that point where they're like, we're definitely selling, now we're going to focus on stuff, but let's go to market. And I would really encourage everybody to say, look, we should have some anticipation of selling at some point in the next few years. Now is the time to do an inventory of what we're good at and what we're not good at, what our value drivers are, and are we in a best position to take our company to market? Because some of those things take time to fix and correct if you need to, and you just can't do that overnight. And so I would encourage you to focus on a couple of these areas. Obviously, quality of financial reporting. We see that particularly with some smaller companies at times where they may not have the internal resources. But if the quality of your financial reporting is not there, it really can undermine the deal value. It can delay the transaction time, and it ultimately can turn off some potential buyers because they don't have the confidence that the data they're looking at or the people that are preparing it are providing numbers that they can rely on. And so, it's very important that you have a good financial reporting group and team. Sometimes that will necessitate maybe you will get an audit in advance of that you may not need today, but I've seen clients because they know the buyer is going to want an audit and where that goes. Quality of earnings. I think that's important. That's not only verifying that the revenue's reported correctly, obviously that's important, but are we in the right revenue lines and streams for our business to maximize our value? Am I selling product that's going to get me a 6-time EBITDA, or am I selling product that's going to get me 11 times EBITDA because we're consistent with current trends and where we're going? I put quality of personnel. Obviously, that's your key people. That's a big part of what organizations buy. Do we have the right people in the right roles? What's their longevity? Do we have them tied up to at least stay through a healthy transition if I'm selling, or beyond, or at least to stay with me through the sale because they're an important part of it? And so, looking at different incentive plans, I think for key personnel is important, particularly when you're looking at a near sale. And finally, tax issues. Again, I spent a lot of time in the tax arena. We've seen at times where tax issues don't get identified until you're actually in the negotiation, due diligence of a tax deal. And again, that can delay timing of a deal, it can delay value of a deal, and ultimately can blow up a deal. So I would encourage people that they may want to go almost through a pre-due diligence type aspect and attack it from what would an outsider think as we would look at issues, whether it's proper structure of shareholders and what they own and the type of entity. State and local issues are a significant portion. Maybe we're not filing in certain states, and private company maybe not highlighting or disclosing some of those areas. And I think that's the type of stuff that we see that comes up in due diligence that really can delay until we get that remedied or increases in escrow or other items that are out there. So I just encourage people to look, hey, we know if some point down the road we're looking to sell, in addition to the things David talks about, that we should make sure that we're taking the time to drive the value of our business through doing some of these things and others. So that's really what I had to share today. So I appreciate you for your time, and I'll hand off to David.
Kurt, thanks. That was a great transition into the areas that I'm going to talk about in regards to what we're looking at from the perspective of any types of business transaction, whether you're going to buy, sell, or merge. What I'm going to talk about is not going to be as completely specific to the food manufacturing role, but more specific to just some general information for transaction advisory and transaction advisory support. Kurt and I work very closely within the firm here in regards to any types of transactions that happen within the firm. Kurt has a lot of high-end experience on the tax side. I've done a lot of transaction work from the perspective of due diligence and some of the post-integration work. So, Kurt, feel free to chime in as I go through some of this stuff. But what we're going to first thing I want to get to is to just and Kurt kind of hit on this a little bit when we were talking about quality of financial statements, personnel, tax issues. That also, if you, whatever you're trying to do, whether it's to buy or sell your business, the first thing you really got to do is you really should look to hire a professional advisor that knows that's been in the market. They've been around. They understand the industry that you're in. They've completed successful transactions in the past. Maybe they're a professional designated, not just a CPA. They could be someone's valuation analyst or someone that's certified in merger and acquisition activities. So, but the reason why we point that out is because many times, as Kurt was talking about before, that we'll get into this. We'll be working with a buyer that's looking to buy from a business, and the seller really doesn't have good representation on their side because they didn't really understand the whole process. So while from our perspective we're working with the buyer and the buyer's getting a good deal out of it, you look at the situation, you say to yourself, if the seller had a real transaction advisor and knew what they were doing and helped them position their company a year or two before to get it to market, they might have gotten a better purchase price, a better market multiple in their business. The other thing too is you want to discuss what you're trying to do sometimes with other professionals that you work with, and that could be your bank, financial professionals, lending institutions. It might be insurance agents and brokers, or it could even be your legal professionals. Specifically, if you're on the buy side, you're going to probably want to have these discussions in advance with your bank or lending institutions because there's a good chance if it's a private deal, you might need bank financing to secure or to be able to complete the deal. If it's from the perspective of just drawing up the transaction and thinking about how you're going to get the deal done, obviously having legal advisors and the right legal team in place to help you with putting the deal together is very important. And then finally, I put in there insurance agents and brokers, and you might ask, well, why would your insurance agent and your broker be important? Well, a lot of times from the perspective of just having the right insurance coverage around officers and directors insurance, things like that, from property and casualty, appraisals of equipment, having those insurance brokers in place that understand the market that you're in and the industry you're in, and having that knowledge can bring a lot of benefit and value to any deal. So let's just move right on to, I kind of broke this down between some key things to consider on the buy side. If you're a buyer and you're inquisitive, you're looking to acquire. And on the sell side, if you're looking to try to position your business. Now, I'm trying to keep this at a very high level because we could probably make this a whole webinar in and of itself. So I'm trying to keep this within a 10-minute time span. So on the buy side, a couple things that you should really consider is number one, what do you if you're the buyer, what are you trying to accomplish? So having strategically thinking through with your board of directors, where do you want to be in 3 to 5 years? What kind of lines of business do you want to get into? Or some of the things you should be thinking of. So the first thing I listed there was increased market share. If is one of the things you're trying to do is to increase your market share regionally, nationally, or even globally. It depends on what you're trying to do, the reach of your business, what your footprint is, what markets you want to get into. Second thing is, is it a strategic product buy? Is it in a line of business? If it's in snack foods, if you're buying a Lake snack food of some sort, Is it in a business where it could be in the pasta industry, and you want to buy something strategically that may be in the sauce industry that makes sauces?
Hey, David, it's a good point you make, and one of the things that was highlighted in the Moody's report recently, where they upgraded the industry outlook, was an expectation of increase in enhanced M&A activity, really more repositioning portfolios to try and bring in those new product lines and shift away from your mainstream focus and complement it with things that really will drive the profitability, and they see that, and that's part of why they upgraded the industry.
Exactly. So I mean, if you know, a lot of companies that we see in the food industry are looking at these strategic buys, looking at something that will complement what they already currently do. May not be just a expansion of their footprint, but maybe something that just complements the product that they're producing already. And then obviously the third side of it would be if you're trying to reduce market competition and trying to acquire or consume the smaller entities out there that may not have the ability or the capacity to compete with you because they don't have the efficiencies and the operations, the management, and the personnel in place that in which they can operate at the margins that you can operate. So reducing the competition and trying to consolidate the industry might be one of your reasons too. On to the next slide there. Some other things to look at too is what can your balance sheet absorb? So, you know, one of the things that, you know, we as accountants always look at is really generating revenue and cash flow is very important, but also the strength of your balance sheet is very important, especially if you're a buyer and you're looking to buy another business. You want to make sure that you've positioned yourself to be able to, and you've positioned yourself and you've done the analysis to figure out what can you actually absorb into your own current balance sheet, because more likely than not, you're probably going to have some debt structure to a transaction that you do. So you want to be able to make sure that you can pay that debt structure back, and you also want to be able to look at what is going to be the return on your investment, how quickly can you return on that investment. So having a good handle on what your balance sheet leverage is and what the capacity on your balance sheet is very important. The other thing you obviously want to do is how will the transaction be financed. Kurt hit on this a little bit in his presentation as well. Clearly, right now that you can do bank debt financing. Banks are very aggressive right now with the low interest rate environment to lend money to acquiring businesses that want to acquire that have a strong balance sheet, that have the ability to cash flow, and in that the product looks like it's a good product to put into their portfolio and their line. Capital investors, being any types of equity investors, private equity investors, obviously are looking at strategic buys. Kurt and I worked on a transaction earlier this year with a buyer that was looking to have some divestiture of his portfolio, and he's in other different types of businesses outside of food. But he bought a food distribution business and brought that into his investment portfolio because it was a high cash flowing business for him. Plus the other thing too, that he was able to acquire the personnel and the management and the machinery and equipment where he could just take it and run it from there. Other ones would be a shareholder financing too. So when I say shareholder financing, you might be a small business or a business that is family owned and run, and you're looking at expanding the business. You might go back to your shareholders and ask for investment back into the business of some sort that will allow for additional capital to go out and purchase another entity. The last thing on there is ensure that activities will not impact the performance of current business operations. So I think all of us sitting around this table can say that we've seen transactions before that have been done with good intention, but then what has ended up happening is that management has had to spend more of their time focusing on that transaction in that business model versus the organic part of the business. And ultimately, at the end of the day, that caused significant strain on the business where they may have actually needed to spin off that acquisition and sell it again, or have had to put a significant investment into the acquired business to try to run it. So while it's great to be on the buy side and you want to be that acquisitive buyer, sometimes you got to step back and take a look at, let's make sure we don't impact the base business. Let's make sure that we can continue to grow the base business as well as pick this up and put this into our portfolio.
I think to that point, David, I would just say that it's important that you have a strong post-merger integration team that has that experience, whether that's internal or external. And I think to your point, where companies get in trouble is, they have a talented team, but they don't necessarily have that experience that they can draw on and anticipate the problems that are coming down the road in a post-merger situation. So it's very, I think, vital from a buy side that you have that right group.
I would agree 100% with you, Kurt. We're going to go to the sell side now. So if you're on the sell side, we talked a little bit about this as well during Kurt's analysis. We're going to try to dig into a little bit more depth with the sell side. The first thing on the sell side that we would tell our clients is first and foremost, make sure you know your own financial statements. You'd be surprised at how often we work with clients that think that they're in a good position to sell their business, but actually they're not in a very good position to sell their business because they're going to have to sell it at a low multiple. They might not have the cash flow and the earnings that could generate the type of income or the type of sales price that they think in their head they might be able to get. So the first thing we like to tell everybody is, and going back to a comment that Kurt said, is that when you're on the sell side, it's not something that just pops up and you do it right away. If you want to get the maximum capacity or the maximum value for your investment, the first thing you want to do is you want to spend a good bit of time on your financial statements and making sure that you understand what's generating your financials and what's generating your revenue and your cash flow. So you want to look at your balance sheet, and you want to look at things like your debt to equity ratio and your current ratios and other business specific ratios that are important drivers for your business. On the income statement, cash is king, I like to say all the time. And, so being able to understand what generates EBITDA and EBIT, as well as what's your true free and available cash flow and your normalized results from that. You want to be able to specifically identify that and be able to talk about that with any acquirer. The other things too is consider a higher level of assurance on your financial statements. So we were talking about that a little earlier too. A lot of times we see compiled statements or reviewed statements with smaller entities. Those entities might benefit from having audited financial statements, just from the perspective of giving the buyer comfort that they've been reviewed, or those financial statements have been audited. The detailed documentation has been done around inventory and fixed assets and receivables. The other thing, too, is assess your operational efficiency and look at things like your management personnel and Lean and Six Sigma type of ideas. And the reason why I bring these up is because operational efficiency, while it's not a dollar value type of entity or a type of business asset, if you want to say, it's intangible. So there is value to that, and there is value in any transaction to having those efficiencies in place or having the right management personnel in place. Same thing with equipment. You want to look at the equipment from an appraisal perspective and what the value of that equipment is. The next thing would be develop financial projections. So after you've got a good handle on your financial statements and where you're at, you want to develop those financial projections that will allow you to look at things from different lines of business and look at this from the perspective of what are some of the new business initiatives that you're driving, what is the organic growth that you're looking at from just the organic piece of the business, operational structure, and what would be some of your capital needs. These would be very important pieces to the puzzle for any buyer to understand, because they're going to want to know what do you have in your what do you have in your pipeline of types of products that you're trying to develop or produce, and research and development. What does your organic pipeline look like? Do you have any new revenue sources out there that wants to buy your product? And then operational structure, and what I mean by that is, management personnel. Do you need to beef up anywhere on the management personnel side to make that to make that transition and have the and what are your capital needs going to be in the future, so you can explain that to any type of acquirer. What would be some of the equipment that you might need, the cost of that equipment, why would it be important to have that piece of equipment in one of your lines of businesses? And then inventory specialized assets. And what I mean by that is, a lot of times you have developed a sauce of some sort, or you have a specific customer list that ties to a specific line of business you have. Those items, those patents, those customer lists, those internally specialized manufacturing processes all have value, and all would be part of the sales price. Maybe you would give a premium to your sales price because it's a patent that you haven't had, that somebody else doesn't have, that you have a specific line of sight on, that would be something that you can sell separately from the business. So having an understanding of what the specialized assets are and what the value of the specialized assets are would be important. Some final considerations to keep in mind too is as you go to market, you always want to make sure that you have a good understanding of what the value of your current equipment is, what the fair market value is. So that fair market value might be very different than what the cost value on your books are. You might want to consider a separate appraisal of just that equipment. Research the market for like kind and recent acquisition data. Using information like we used earlier, Mike has some very good information from IBIS World. I'm a valuation analyst. We use IBIS World on a regular basis. RMA and Pratt Stats, which I didn't put Pratt Stats on here, is very good market databases for obtaining market multiples and industry transaction data. That's private. It's private information, but you can get some good market multiples and market data on that. And then obviously going through different food manufacturing organizations, such as what Mike did earlier with his presentation and pulling some data up. Last thing, the next two things would be complete an assessment of range of value of the business. There's obviously different valuation approaches there, asset, income, and market multiple approaches. You want to probably try to do a blend of all three of those approaches, have a good valuation analyst that understands what they're doing in that area to help you with coming up with what that range of value might be. And then obviously preparing the confidential memorandum before you go to market so you have something to provide to any type of acquirer. So I know I ran through the last couple things there a little quickly because we're running short on time. Mike's holding his hand up over here, so he's got a question.
Just a question for you on that. The mindset of a seller and a business owner who is looking at multiples, and we look at multiples that are very attractive right now. Well, maybe down a little bit so far this year, but very attractive compared to historical. And when you think of the idea of multiple, it's all based on my EBITDA. So how do you overcome, if you're speaking to a business owner, the idea of spending money now to enhance the value? So I think of the food labeling requirements that are fairly new and are not effective for another year and a half, 2.5 if you're a smaller company. That's going to take a significant investment. So if I'm thinking of selling, do I start down that path and invest the money in it, or do I let someone else take care of it? If I need to do a process re-engineering and do a lean restructure of my line, it's going to cost me money now. So should I spend that money now and maybe decrease the idea of what the multiple is? How do you address the business owner who's not thinking that way?
Mike, that's a great question. So understanding up front where you're at currently with your business and doing maybe a business valuation initially to kind of help you come up with what the range of value is and what the market multiples are today. One of the things you're going to have to do is you're going to have to look at things like EBITDA and cash flow. So looking at those things initially and then having in mind what that owner might be thinking, what the current value of the business is, they could be completely two different scenarios. So you might have $1 million is what the real value is. They may have $5 million in their head. So understanding, okay, well, what are some of the things in the business right now that you're not doing that you could be doing? If you invest some money in up front now to do it, could increase your profitability and increase your EBITDA. Things like Lean, Six Sigma might be something that you want to consider. Looking at different process efficiencies. While it might cost you money up front, if it's a tenfold return on your investment, it would be worth doing it. But they would be things that you would want to have a professional advisor help you with understanding whether you want to put that type of money up and what the return is going to be for you if by putting those types of processes in place.
If I just conclude on that point, I would just say the one thing too is sometimes we focus just on EBITDA and not understand the multiples and what's impacting them. So if some of these investments we're making, even if they reduce EBITDA, but it drive me from a 6 multiple to a 10 multiple opportunity, it can significantly drive the value of our business from an enterprise value. So the main thing is know what drives those values and understand if you're aligned with them or what you need to do to get there.
Thank you once again for joining us for this presentation produced by McConley and Asbury. We hope you join us for our upcoming events. You can stay up to date with news and learn more about our upcoming events by visiting us at www.macpas.com. Thanks again, and have a great day.